Hello, and welcome back to Retire with Oakleaf. I'm Vasily, or just V, and I'm sitting here with Matt.
Hello, everybody. Thanks for joining us.
Today, we would like to touch on a very important, timely, as ever, topic, which is required minimum distributions, or RMDs.
There you go.
So to get us started here, Matt, what are they? What's an RMD?
Very good question. And it is, I think it's something when you know you've made it in a way, you lived a long life because you've reached the age where the government actually starts to make you take money out of your pre-tax accounts if you're not doing so already. So you've gotten a tax break, if you will, a tax deferral when you put money into pre-tax IRAs, 401ks, 403bs, any pre-tax vehicle. You've gotten tax deferred growth all this time. And so Uncle Sam says, I want some of my money now. Before you pass away and pass it on to next generations, you have to start taking some income from these. And we get a lot of questions on when they actually start, because there's been quite a few rule changes on the age over the last, I'd say, 5 or 6 years or so. So the rules as they currently stand, when you turn 73, so if you're born 1960 or before, your required minimum distribution age, RMD age, is age 73. If you're born 1960 or after, it's 75. And what that means when you get to that age is there is a life expectancy table that the IRS uses that calculates what your year-end account balance was from the prior year, what age you are at that time, and that basically tells you what percentage of the account and dollar value you have to take out in that calendar year.
Got it. And why is that a big deal?
It can be a big deal if you are not, one, from a tax perspective, planning for additional income, because 100% typically of this withdrawal will generate a tax form. Whether it's taxable or not does depend on your tax situation, but it could be a surprise to some if they are not already taking money out of their accounts and now they have to figure out either A, what they do with their excess income, which could be a good problem to have, or B, how much taxes do I withhold? Is this going to push me into another tax bracket with my other income? What if I truly don't need it and I don't want it to sit in the bank? Can I reinvest it somewhere else? These questions typically arise when folks get closer to this age.
Got it.
And it can be very confusing, especially if you're reading some of the articles online. Some of them were produced when the age was 70 and a half, and then it was 72, so things have changed a lot. So with that too, V, I think we get a lot of questions around, is this a big deal for me? Because there's a lot of information online of required minimum distributions are this big, scary life event. And I think we find for some clients it can be, and some of it's just an education piece, and some of them it's really not, because they're already taking money out. So if you could just expand on your experience with clients in that realm.
Yeah, sure. So two very important areas of focus around the RMDs and required minimum distributions. One is education, knowing what they are and knowing that they're coming. And the second is planning for them. If you need the funds for lifestyle expenses, that's great, not a ton of planning needed there. However, if you don't need them, or if the income is going to inevitably push you to a higher Medicare, IRMA premium bracket, then you do need to put something in place in anticipation of this increase in premiums. So Matt, what is typically a couple of different strategies and options that we see people take, and we recommend and advise people take, that do not necessarily need the funds, but they have to take the funds because they just turned 73?
Certainly, and even before they turn 73, if clients do have enough of a runway and we can pull some levers with timing of Social Security and other income sources, if clients really want to reduce their RMDs, we could look at Roth conversions in years ahead. You do have to have a long enough runway, and you do have to make some assumptions about what tax rates are going to look like down the road and IRMA brackets as well. So it's not a perfect science by any means, but if somebody is going to have a tax bomb, if you will, and they want to at least for estate planning purposes have some of that be Roth to pass along a little bit more efficiently, that's something we can look at. Secondly to that, if they do not need the funds and they are charitably inclined, they could look at what's called a qualified charitable distribution. A couple of fun facts here. You actually don't need to be RMD age to utilize QCDs. You only need to be 70 and a half, and I think that's because that used to be the RMD age, 70 and a half. You can gift up to $108,000 of your pre-tax balance each year as a QCD. So it can be above and beyond what your required minimum distribution is. And that's per taxpayer. So if you're a couple, that could be $216,000 of pre-tax IRA money that you could be gifting directly out of your IRA to a charity and not have to pay any income taxes on it. So again, it is a little bit of a niche topic because you do have to be charitably inclined. Of course, you don't need to max out the allowable amount. Any amount, I'm sure, is appreciated by these organizations, but it just is another avenue that you can satisfy a charitable endeavor and also not pay taxes on the amount you have to take out. And I think even there too, V, the third piece there when you think of planning for this is a lot of people think of taxation. I'm going to have to pull this money out and I'm going to go into a higher tax bracket, or I'm going to go to a higher earn bracket. And as I kind of touched on briefly, we don't know some of these variables and what they're going to look like. For example, going into the 2025, we weren't sure if the Tax Cuts and Jobs Act changes for the tax brackets were going to sunset. We weren't sure. So you could be a little bit antsy and make some decisions prematurely. But we always really try and think of RMDs and taxes as a lifetime game, if you will. 1 year isn't going to necessarily derive a result that's going to affect the rest of your retirement. So you really want to look at this from a binocular view, in the sense where you're looking and it's really grainy what you can see up front, but if you look over the horizon, you can at least do some planning on what's ahead.
Excellent. And this is the importance of having a plan in place, talking to your financial planning team in anticipation of these milestones coming up, whether it's RMDs, whether you're charitably inclined, and you can kind of combine both, effectively decreasing that tax bomb effect, if you will. It is critical to plan ahead and not just wait until the very last minute, and God forbid, don't forget to take the required minimum distribution, as Uncle Sam does not take lightly to it. It used to be a little easier to appeal. It is not as easy anymore, and the penalty is 25% of the amount you were supposed to take. So please do not forget to take your RMDs.
And you pay taxes on top of that amount, correct?
And correct, yes. So not only you pay the 25% penalty, but you also pay taxes on the amount that you're paying to the IRS. So again, critically important, mission critical, take your RMDs.
All right, V, so to end on a little bit of a more fun note, a little bit of lightning round here, we get a question around this time of year of folks who have birthdays in November and December. So end of the calendar year, they're turning 73. They now are required to take RMDs, but a question becomes, when do I have to take it? If I turn 73 on December 1st, for example, when am I required to take that first RMD without being penalized? Mm-hmm. And if I don't take it by December 31st, what happens, if anything?
Great question. So typically, the IRS does not really give breaks, but this is one of those rare occasions where they actually do give a break. So assuming that you turn 73 around December, so towards the end of the year, you have to take an RMD for the year. However, you have until April 1st of the following year, meaning whether you turn 73 December 1st or December 31st, you do have until April 1st of the following year to take that year's RMD. However, things get a little bit murky and tricky here, because now for that following year, you have to satisfy that first RMD until April 1st, but then from April 1st to December 31st, you have to take another RMD to satisfy that second year. So now what this can be a little bit puzzling for clients is maybe they forget, maybe they don't take it in the year of which they turn 73 because they have that break from the IRS. But now what that means is that they take a double distribution in the following year, which for some it may not be problematic. However, it can absolutely push people to higher tax brackets, IRMA brackets, and so on and so forth. So what we advise folks to do is, again, have a plan in place, revisit the plan, project what your numbers will be. It may not be as painful to take two distributions in the same year. However, typically it makes the most sense, if possible, to take it the year that you're turning 73, unless there is any other strategy in place that you're trying to reduce that income for the year. So you split the two distributions individually on a per year basis.
Sure, absolutely. And then one more question on there as well is along those same lines. If I'm turning 73 December 1st, but when I start the year on January 1st, I'm 72 still, should I start taking my RMD in January? Should I wait to take a lump sum in December? Should I take it quarterly? How do we typically see clients approach that?
Good question. So that depends on the individual needs, the household expenditures, and the plan that we've put in place. We do have clients that choose the monthly option because that feels more like a check, if you will. We have folks that do the lump sum at the beginning or the end of the year because they're expecting large expense items coming up at the beginning or the end. So it's a preference point, but we still need to plan for it so we can all be on the same page regarding your investments, the allocation, the accounts, and when does this outlay of funds is projected to be.
Very good. Well said. I hope you enjoyed this episode of Retire with Oakleaf. I'm Matt with Willette. This is V. Again, we're going to be back here hopefully every week with a new video. If folks do have individual questions and want to discuss the situation, we do have our contact information below in the bio as well and a link to our website. Please feel free to reach out. We're more than happy to schedule time to chat, and we have clients all over the country, so virtual and person is always good.
Great.
Bye now.
Bye.